You're in the Business Insurance Zone with me, Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. This week on The Biz, the mid-year life insurance review for 2013. And on today's show, AG38 recap and AG37 VUL with Bobby Samuelson, editor of Life Product Review.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. Of course, I'm your host, Steve Savant, and we're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today, the millennial marketer himself, Bobby Samuelson. Hey, Bobby.
Hey, how's it going?
Well, remember, I don't have too many people that are under 35, so I gotta kind of go with that.
Yes, that's true.
I want to talk about right off the get-go, kind of a redux, and I want to put this to bed. AG38. Is it to bed now? Can we actually do a redux and we're done with it?
I think AG38 itself is probably put to bed. So quick summary of kind of what happened. I mean, look, this thing came out in early 2000s, 2001, 2002, 2003. It's a 9-step calculation that says, look, guaranteed products are different than normal life insurance products, so we have to have sort of a bolt-on extra reserve for these contracts, and that's what we call AG38. Started out kind of AXXX, XXX, all that sort of stuff, molded into this AG38 thing. And long story short, that's a 9-step calculation that if you read it, has some fairly kind of ambiguous language in it. And so over time what happened was that language would kind of have a hole in it, and carriers would kind of push products through that hole and create products that allow them to hold less reserves than you would probably otherwise think under the spirit of the AG38 regulation. And in 2006, they changed the rules. They added a new section that clarified the language and kind of stopped a lot of that stuff. And then after 2006, there was another hole in the language, and that's basically what got closed last year when New York started to investigate this and kind of look at some of the, I think New York called them abuses. I would call them creative actuarial techniques that the carriers were using to hold less reserves than you would otherwise expect under AG38. So what happened last year was, New York came out and said, look, there are trap doors inside of these products that are not for the consumer. They're there specifically to minimize reserves, excess reserves under AG38. And so we're going to change the language again and close that door. So effective January 1, 2013, that door has essentially been closed. The language has been adequately clarified, and now carriers are basically in full compliance with AG38.
Did this eliminate shadow accounts?
No, absolutely not.
Okay.
Yeah, it didn't.
Yeah.
So what, the question is, well, what's a shadow account, right? I mean, a shadow account is just one way of calculating whether or not a policy is actually in force. And you can do that several ways, right? You can do a cumulative premium guarantee where if you pay a certain amount of premium over any specified period of time, you get a guarantee. What shadow accounts allow is mechanics that are a lot more flexible. And so you can have clients that in theory could have flexible premium payments, could kind of have the normal benefits of flexibility like in a UL contract, but they do it using the shadow account methodology. Now, shadow accounts turned into a way for carriers to get around the AG38 reserves, because what happens is the shadow accounts can be a very complex mechanism, and that complexity was, I think, a lot of times directly related to what AG38 said and how carriers can kind of get around those rules. And by the way, the way the carriers look at this is, a lot of carriers looked at this. Oh, let me back up. The ones that were doing this looked at this was, these are excess reserves. These are unnecessary. They call them redundant reserves. And so economically, we don't really have to hold them, which is why we feel comfortable sort of, I would say, using these loopholes to hold less of them. So no, shadow accounts are still here. In theory, they should change. They should get a lot simpler and kind of go back to what they should be doing, which is really just providing a mechanical engine for these guarantees, not so much about kind of cheating on the AG38 reserve thing. But they're still here to stay, and you'll see all new products with shadow accounts.
Okay, but now remember, they got in trouble. We had carriers billing the client for more money than the guaranteed premium because they didn't pay exactly on time.
Yeah.
Is that still online with this new reconfiguration of AG38?
So theoretically, no, but yes, right? So if you read the regulation doesn't say, hey, you can or can't penalize clients for paying early or paying late or whatever. But if you look at the way a normal universal life contract works, there aren't penalties that are kind of surprise, like trapdoor type penalties. The mechanics are pretty clean and straightforward. Well, all this complexity in the shadow accounts that, again, a lot of times was related to AG38, sometimes wasn't related to AG38, that's what causes all the problems you're talking about, where clients skip premiums, pay late, pay early, and all of a sudden have these massive unexpected consequences. You know, things like a guy in Palm Beach that I know had a client who paid 3 days early, and his guarantee went from 110 to 95. And that's just because shadow accounts are complicated, and you could argue that that had to do with AG38, but the reality is carriers are just building trapdoors into these things, and so they're just very complex instruments. I mean, the reality is, look, if you want to sell guaranteed UL, now or in the past, you have to read every single policy contract you sell to see if there are trapdoors in these things.
Well, I just have to say, as a basic guy, I'm just a basic person, and I have to now read the mechanical language, legal language, to see if there's a trigger for a secondary guarantee to actually charge or bill the client more premium. I'm saying no agent is going to do that.
No agent read the original contract.
No.
So, but here's the thing, that's what's required.
Well,
because the reality is clients pay late and pay early over time. Clients skip premium payments. I mean, premium payments, the only time they're ever exactly what they should be is on the illustration. Otherwise, in the real world, crazy things happen, right?
Well,
and so if you think your client's going to deviate from the scheduled premium stream over any time in the future, you have to read that policy contract to find out. And what you'll see if you do that is that there are some policies that heavily penalize you. Now, new policies, even AG38 compliant policies, that heavily penalize you. And there are other policies that really don't penalize you any more than you would have in a normal current assumption UL contract. So the spread is huge, and the problem is we benchmark based on price. So what you can have is a cheap, very risky product and a slightly more expensive, very low risk product where you have a lot of flexibility. And so which one should you have? Well, on the spreadsheet, you should have the cheap one, but in reality, you should probably have the little bit more expensive one. So that's the dilemma. And again, you can't know that as an agent unless you read the contracts or have someone read the contracts for you.
I just want to say, Bobby, I have plenty of PowerPoint presentations from carriers that were offered up by their wholesalers, and none of this read the language deep is in any of it.
Do you think the wholesalers read the contract?
Oh, no. Well, when we come back from the break, we're going to talk about AG37, the VUL comeback, with Executive Editor of Life Product Review, Bobby Samuelson. And don't forget, you can visit IULUniversity.com for the best training and education when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
You know, living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Bobby Samuelson. And remember, you can order today's materials at thebiz.tv. And while you're out there, click on the backroom technician icon right on the Biz blog for their 30-day free trial offer for the best needs analysis and education material that address almost every financial planning scenario. And just a heads up, before moving forward with any of the things you hear on our show, always check in with your tax advisor or legal counsel, as well as your broker-dealer compliance officer if you are so FINRA licensed, and I'm sure my compliance officer is loving that. We're talking about now today with Bobby Samuelson, AG37, because now I hear the rumor that, Steve, the actual reserves for variable are considerably less than GUL. Is that true?
I don't think that's necessarily true. I think when you look at the way AG37 was originally designed, it was designed to mirror AG38. So these are very similar, and in reality, they should be very close to one another. I think there's a good argument that can be made that AG37 has slightly less reserves than a fully compliant AG38 product. You know, the problem was for the last 10 years, companies weren't fully compliant. And so they were holding less reserves, and so AG37 essentially penalized them versus what they could get away with on AG38. So now that AG38's been cleaned up, I think AG37 has maybe a slightly lower reserve requirement, but I can tell you that regulation has not been updated in years. And so I think the question that no one quite has an answer to yet, and I certainly don't, is are some of these companies that are doing guaranteed VUL contracts, had they found a loophole in AG37? And I think there's an argument to be made, especially one carrier in particular has a unique mechanism that I think there's some pretty good evidence for that they're using that to sort of minimize their AG37 reserves. So that's the deal with AG37. I don't think it's necessarily less, but I think there may be some, again, some ambiguity there.
Well, if illustrations are any indication, and I ran several of the top 10, I did 10 of them, VUL income scenarios, and used the same indexing product with the same M&E, I noticed, why is this one carrier, I think, substantially less than the others? And I think there was no other way to explain it except that their reserves were lower and they priced it differently.
For income distributions?
For income distribution.
I don't know about that. Did that one product have a guarantee on it?
It did.
It did? Okay.
Yeah.
I think the guarantee issue is a little different than the income distribution scenario because when you think about AG37, that's really for, that's basically pricing in the probability of triggering that no lapse guarantee provision in a VUL contract. So really it's less about an income and it's a lot more about what may happen if you try to, let's say, level premium pay a guarantee in the policy. What AG37 is essentially trying to kind of calibrate is if you're a life insurance company and you take premiums in, okay, and it's a VUL contract, that money has to go into the separate accounts, right? Which means that what you actually take in is only the policy charges in the contract, all right? But now imagine this. Let's say that you're a company, you've taken in policy charges for 3 or 4 years, you're providing a death benefit guarantee, and all of a sudden equity markets drop 50%, right? Now all of a sudden you're on the hook for all that decline in the separate account value because now if the client dies, you'd have to pay out the difference and all the equity, and the equity markets decline, and that's why, right? But what you took in is exactly the same. So what AG37 is trying to do is say, we recognize that in guaranteed VUL, there's a lot of risk there because if equity markets go up or down a lot, the carrier is basically on the hook for the difference if the client dies. So that's how the reserving for AG38 sort of impacts it. And the challenge for insurance companies is that's very different than AG38 GUL policies because if you think about it, when you pay premium into a GUL, how much cash value is there? Zero,
None.
right? Yeah. But on AG37, guaranteed VUL contracts, you have cash value. There's volatility in that cash value, but the carrier only receives the policy charges in the contract.
I don't want to really punt back to 38 for a second, but a thought just came into my mind. I see there's 2 carriers out there that have GUL. They've already done the AG38 compliance, but I've noticed that they have 25% cash value at life expectancy, 50% at age 100, and 100% at age 120. What's going on?
Guaranteed cash values.
Yes.
Yeah, so
what's going on there?
Well, it's interesting. I've read those contracts. I know which ones you're talking about. And that there are a couple, I think, of different reasons to that. That is actually an interesting product because there are basically 3 layers of guarantees going on here. There's the guaranteed cash values the way we normally think of them. There's the shadow account. And then there are these actually guaranteed cash value factors that are linked up to the shadow account. So you have a very complex layering process there. If I was being completely honest, what I really think they're doing is, well, there are some benefits to having this layering, obviously. But if you're old and you may not be dying for a while, or you need cash now, or whatever, you may have an incentive to lapse the policy and take that guaranteed cash value. And in that event, that lapse would be extremely profitable for the insurance company because you'd be lapsing a policy that has 50% or whatever of the death benefit to get that cash, and that would be profitable. And so I think the carriers are kind of building in an incentive maybe for later on for people to lapse instead of maintain those policies, which would be profitable for the insurer.
Well, I was surprised that after AG38, that these companies still kept that basic cash value at life expectancy, age 100, and endowment.
So those are actually, a lot of that AG38 stuff was really playing out in the shadow account. These guaranteed cash value factors are a little different. But I'll tell you too, those 2 contracts you're talking about have not actually been updated for the new AG38 rules. So both of them have some very complex 2-tier shadow account, multiple premium load stuff going on in the background. So if you actually look at the filings in Wisconsin, South Dakota, and Florida, which is where you can pretty easily get policy filings, those are all 2010, 2011 contracts, and one of them was 2012, but didn't change at all for the new AG38 rules. So essentially what happens is companies didn't have to refile a contract for AG38. They just had to not take a reserve credit for reserving purposes. But the same policy could be there, right? And that's essentially what they did is they just kept the old policies out. And so that's why you didn't see a change.
For the players that stayed with VUL AG37 and regular GUL with AG38, the people that stayed in the market, I saw very little reconfiguration of premium.
Yeah, I think that's fair. I think you're talking about really just a couple of companies. One of those companies did refile a new product early in 2012 to kind of clean up the AG38 thing. Now they have a very complicated product, but they basically updated their guaranteed VUL to make that their workhorse, and their sales are up dramatically. So I think the main issue is, look, there's a lot of ambiguity about these things still. Don't think VUL Get with Guarantee is going to take over the world, all right, because it's not.
Oh, no, it's not. Well, listen, tomorrow we're going to talk more about this with Bobby Samuelson. You can follow me on Twitter, Facebook, LinkedIn, and email me at steve@thebiz.tv. You've been in the zone, the business insurance zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.